August 11, 2020, 11 p.m. Somewhere inside Citibank's operations center, a single keystroke changed everything. One employee, one screen, one catastrophic confirmation, $900 million, wired out, gone. Not the $7.8 million that was supposed to move, nearly $1 billion sent to hedge funds who had no reason to give it back. This wasn't a heist. There were no hackers, no criminals breaking down doors, just a drop-down menu, a checkbox, and a mistake that would trigger one of the most stunning legal battles in American financial history. August 11, 2020. A single keystroke inside Citibank's operations center triggers a financial catastrophe unlike anything Wall Street had ever witnessed. $900 million, not thousands, not millions, 900 million, vanishes into the accounts of hedge funds overnight. Within hours, Bloomberg alerts are firing. Reuters is scrambling. The Wall Street Journal can barely believe what it's reporting. This wasn't a hack. This wasn't fraud. This was a mistake. And what happened next would rewrite the legal rulebook for banking forever. 3 players. One catastrophic mistake. In August 2020, Citibank sat at the center of a financial web as loan agent for Revlon, the iconic but debt-drowning cosmetics empire. On one side, a Wall Street giant managing billions in complex syndicated loans. On the other, roughly 10 sharp-edged hedge funds, battle-hardened creditors who had been circling Revlon's distressed debt for years. Nobody expected what happened next, and when they woke up to 9-figure deposits they never earned, the real fight had only just begun. Revlon was once untouchable, the lipstick that outlasted the Great Depression, the fragrance that defined Hollywood glamour. But by 2020, that empire was drowning. Debt had ballooned past $3 billion. Pandemic lockdowns had gutted cosmetic sales overnight. Creditors weren't just nervous, they were already suing each other. And Citibank, caught in the middle as administrative agent, was managing a loan portfolio sitting on a financial fault line, one wrong move away from catastrophe. At the center of this disaster was a piece of software called FlexCube, Citibank's internal loan management system. To send an interest payment, an operator had to navigate a labyrinthine interface requiring 3 separate approvers in what the bank called a 6 eyes process. But here's the fatal flaw. A single checkbox, buried inside a subscreen, controlled whether the principal loan amount was included in the transfer. Check the wrong box, or miss it entirely, and you weren't sending thousands. You were sending everything. August 11, 2020, a Tuesday night. Inside Citibank's loan operations center, employees raced against a deadline to process what should have been a routine $7.8 million interest payment on Revlon's debt. But the software screen, a legacy system called FlexCube, had a treacherous default setting. 3 separate employees reviewed the transaction, 3 separate employees approved it. None caught the error. At 8:51 p.m., 893,906, 342.08 left Citibank's accounts. By morning, it was simply gone. By 9 a.m. the next morning, Citibank's operations floor had transformed into a war room. Phones rang without pause. Compliance officers scrambled through transaction logs, confirming what no one wanted to believe. $900 million had left the building. Emergency calls went out to the receiving hedge funds. The message urgent and unambiguous. Return the money immediately. But on the other end of those calls, fund managers weren't panicking. They were dialing their own lawyers. In finance, receiving an erroneous wire doesn't automatically mean giving it back. Not everyone picked up the phone. Brigade Capital Management, HPS Investment Partners, Symphony Asset Management, these were not reckless actors. They were sophisticated creditors who had spent years fighting Revlon's debt restructuring. When $900 million landed in their accounts, their lawyers didn't see an error. They saw payment. Under the legal doctrine known as discharge for value, if a creditor receives money they are legitimately owed, in good faith they are under no obligation to return it. Citibank had just handed them a loaded legal shield. But here is where the story fractures. Some creditors, the ones who picked up the phone, who did the math, who felt the weight of a moral obligation, wired the money back. No litigation required. Then there were the others. Roughly 10 hedge funds, collectively holding nearly $500 million, drew a line. They had received the funds legally, they argued. Under New York's discharge for value rule, the the money was theirs. Ethics said return it. The law, they gambled, might say something different entirely. Citibank filed suit in the Southern District of New York, demanding its money back. But the hedge funds had a weapon Citibank never anticipated, a 172-year-old legal doctrine called discharge for value. Presiding over the case was Judge Jesse Furman, a sharp, methodical jurist who would now wrestle with a question almost no court had faced at this magnitude. If a creditor receives money, they're legitimately owed in good faith, with no reason to suspect error. Does the law actually require them to return it? Legal historians would call what followed unprecedented. Inside the Southern District of New York, two legal philosophies collided. Citibank's attorneys hammered a single point. No sophisticated financial firm could genuinely believe a $900 million wire was intentional. Judge Jesse Furman pushed back hard, asking whether good faith even mattered if the debt was legitimately owed. The hedge fund's lawyers were surgical, their clients were creditors, the money satisfied real obligations, and the law didn't require them to read Citibank's mind. Furman's ruling would ultimately agree. Mistake or not, the law had a different definition of fairness. February 16, 2021. Judge Jesse Furman delivers a 101-page verdict that shakes Wall Street to its foundation. His ruling invokes the discharge for value doctrine, an obscure legal principle stating that if a creditor receives money they were legitimately owed, they can keep it regardless of how it arrived. The hedge funds had done nothing wrong. Citibank's catastrophic operational error was Citibank's problem alone. In one sweeping decision, $500 million in disputed funds became permanently, legally theirs. The legal defeat was only the beginning. In October 2020, the Office of the Comptroller of the Currency levied a $400 million fine against Citibank, not solely for the wire transfer disaster, but for years of systemic failures in risk management, data governance, and internal controls. Regulators had seen enough. One of the world's most powerful financial institutions had been running on fraying infrastructure and blind trust in outdated systems. The Revlon incident wasn't an accident. It was a symptom. The fallout forced Citibank into action. A multi-billion-dollar technology overhaul began dismantling decades of layered, brittle software. Systems so old, some ran on code written before the internet existed. But Citibank wasn't alone in its vulnerability. Across Wall Street, regulators and fintech experts sounded a quiet alarm. The global financial system's plumbing was dangerously outdated. $900 million had exposed a crack running beneath every major institution on Earth. What does it mean to be legally right but morally hollow? The hedge funds kept money they knew wasn't theirs, and the court said that's acceptable. The Citibank case didn't just expose a software flaw or a sleepy operator's mistake. It exposed something deeper, that trillion-dollar systems balancing the global economy rest ultimately on human fingers hitting the wrong keys. Citibank eventually recovered a portion through appeals. But the real legacy, every wire transfer protocol in the world was quietly rewritten because of one blinking cursor on one August night.